hit. Prashant Khemka is joining us, founder at WhiteOak Capital Management. Like we keep discussing, one of the biggest fund managers, if not the biggest in India right now. Prashant, good morning. Thanks a lot for joining us.
Good morning, Anand.
You tell us, are you fully invested right now, or are you sitting on cash levels? How are you approaching this market volatility? I'm sure even your portfolios would have taken a hit. How are you approaching it?
Certainly. So, Anuj, as we've discussed before, we think market is impossible to predict going ahead at any time. And we, as we've always told our clients as well, we always stay fully invested. It's our client's decision whether they want to reduce exposure to the market, but we don't try and add value because it's not very difficult, but it is impossible to add value by trying to call the market in the near term, and hence we stay more or less fully invested. 1, 2, 3, 4% cash from liquidity perspective, maybe they're in portfolios that the team maintains.
Okay, Prashant, good morning. Thank you very much for joining us. Really very eager to hear you in what's a difficult moment for investors. All through 2020 and 2021, I was bemoaning that the markets are climbing when the economy was tanking, we were contracting. And now the economy is actually doing well. Great GST collections, even autos seem to be turning the corner, CVs have turned the corner, and hiring, just anybody who talks about hiring, including CMI, who is very careful with its analysis, is talking about, bustling in the hiring market, in the labor market. So, how do you approach stocks at this juncture? Do you start buying the consumer stocks?
So, no, certainly, Lata, thanks for that question. As you know, Lata, better than anyone else, markets being discounting mechanism, they are looking forward. Back then, while we all were very worried in personal lives about COVID and whatnot, what the market really cared was whether the pandemic would force people to stay at home, and market really recognized that the pandemic won't force people to stay at home. Today, the situation is very different. So 2 years ago, the risk when market initially tanked about 2 years and a quarter ago, the risk was demand destruction. If everyone stayed at home, you can imagine, Lata, the demand destruction in various spheres of the economy. Travel would go for a toss. All travel, tourism, hotels, all would go bankrupt if people were to stay locked up. Oil companies, crude went to negative on spot basis because people felt that because nobody is going to use oil getting out of homes, then you'll have to pay big sums to store crude, and hence negative oil price, because there was a demand destruction risk.
Yeah.
Demand destruction risk which we have never seen before. But that did not play out, and hence the sharp reversal. Today, the scenario is complete opposite. It is supply destruction risk.
Okay.
We were already suffering from supply chain disruptions related to China and other places around the world. With Russia-Ukraine war, there has been a major supply shock, not just disruption. And this seems now that might go on for very long, as settlement talks, which were there once in a while, have now also dissipated. So this is more of a supply side shock, and given that this could lead to, and again remains to be seen, if tomorrow Russia-Ukraine, there is some kind of a settlement, all these things, just like the war started as a very major surprise, settlement might also come as a surprise, this time pleasant one. We don't know, but if there were to be such settlement, things can again, the market would again look ahead, and the risk of stronger inflation for longer time frame might wane away. But as things stand today, the market is worried about, I think one of the things market is, besides many others, worried about is the inflation staying higher, because remember, China is still imposing one of the harshest lockdowns. So the supply chain, first of all, Russia provides the commodities, 10% of oil, a big chunk of aluminum, steel, and whatnot. And those commodities are then used by China to manufacture a lot of the stuff that the rest of the world uses. So there's at the source, there is a shock in the materials, and then the manufacturing, also there is still ongoing disruption. And that is what I think the concerns are about, this inflation causing slowdown in real demand.
Oh, absolutely. So, to bring it back to viewers who are eagerly waiting on every word that you're saying, if it was your own money and you had cash, where would you seek safe harbor? Would you seek it in
Sorry,
some of the
yes.
large stocks? Would you seek it in commodities? What would you do?
Certainly, Lata. So on that one, we always maintain a good balance. We don't try to chase what is currently looking very safe. Because again, sorry to take you back to the COVID time. There's such a perfect example for illustration. Remember when we were in the midst of COVID mayhem in the market, every investment guru said pharma is the place to be. Because it seemed like we would be only consuming pills and vaccines and vitamins for long time to come, sitting at home. And then pharma has been one of the worst sectors since then. So today it might seem like commodities is the place to be. These are the only things that are going to work. But you don't know, just like 2 years, the world has changed completely, or the risk that the market is focused on has changed completely. That may happen again. So we remain well balanced across board.
Okay.
We have investments in some of these commodity stocks, but we remain invested similarly in consumer, to your point, in IT services, financials, because consumer, particularly that people are very worried about with inflation and input prices and all. If we look back, and some of the leading companies on their con calls also mention that when inflation is there and commodity prices, the larger, well-established brand tend to manage these pressures far better than unorganized or weaker peers, weaker competitors. And during these times, they tend to gain good market share, which is, while there is near-term hit to the earnings, this year's cash flow and earnings, but they sustainably might gain market share for future. That's far more value accretive. So that's how our view is, Lata. We remain invested at all times, even during COVID, during now, across various sectors, and don't try to chase the sectors that today might seem to be in good spot.
All right. Hi, Mr. Khemka. Morning. I wanted to ask you about what sort of a phase we are in terms of the markets. Do you think it's too early to call out that the ghost of 2008? I wasn't in the hot seat at that time, but I saw this painful phase, between 2018 to 2020, when the index didn't move too much. It corrected 5, 7, 8% odd, but portfolios got absolutely smashed for those 2 years odd. Your take?
Very true, Nigel. Look, the ghost of 2008 would remain with all of us who were there for the rest of our lives. So can't escape that. And anytime any such crisis comes up, it would seem like a repeat of the GFC crisis. But to your question, 2018-19 time period was, yes, very painful, because the broader markets, if you look back, 2018 and 19 were the two back-to-back worst years for small cap and mid cap indices in the last 20 years at least. And hence the pain, while the index didn't move a whole lot, mid and small caps did extremely poorly. Now, again, we don't call from top-down perspective that large caps would do better, mid caps would do better, small caps would do better. But yes, over the last 2 years, in maybe 3-4 years, there has been a broad-based, very broad-based rally. I mean, from over the last, while we are bemoaning, obviously, this close to 10% as of today, pullback in year-to-date basis on S&P 500. Remember, we are still up, I think, around 35-40% on a 2-year basis from the pre-COVID levels. From the COVID bottoms, we might be still up nearly 100%, right? So, and mid and small caps have led this sharp upswing. So, and last 12 to 18 months, the market has drawn in so many retail investors. All the numbers are there. The demat accounts have soared through the roof. All the new age brokerage, fintech, so-called companies who are providing almost free of cost trading opportunities have drawn in tens or no other time have we seen such sharp increase. Maybe going back to Harshad Mehta time was the last time when we saw such sharp increase in new traders. They're not used to losses.
Yeah.
They think market can deliver 30, 40, 50% return every year. I mean, it's good because that's how I got sucked into the market back in 85 when markets went up 100%. But then they're going to get reality check. And that might be very painful for many of them. They might exit. And that's what causes the broad-based declines.
Absolutely.
I'm not saying that's going to happen, but that risk is...
No. Absolutely, Prashant. That's been my biggest concern. I've been expressing it on air that a lot of people who've entered market in 2021 have not seen a bear market, and extrapolation is perhaps the biggest mistake that you can make in stock markets, right? Because the market has done something in 2021, it will keep doing that. I know a lot of people have left their full-time jobs. Of course, post-COVID, some of them had to leave, but then they saw that in stock markets they were making 4 or 5 times of what they were making, and they thought, okay, this is the way of life. And now there's a rude reality check for a lot of them. I do get a lot of distress letters. By the way, the Nifty has broken 5,900. Forget about 16,000. 5,900 is also gone. On a closing basis, the low was 15,863, and on an intraday basis was 15,671. Now, Prashant, in terms of portfolios from here on, there's been one call that's been made that time has come to buy commodity consumers and sell the commodities because that trade perhaps is over. Do you sit in that camp, or do you think it might be a bit too early, especially with names like autos?
Certainly. Okay, so you mean commodity consumers. So, again, sorry for a bit of repetition, Anuj, but we do own both sides. But in general, structurally speaking, and that has hurt us year to date, we struggle to find great lot of attractive opportunities in commodity sectors, pure commodities. We have some exposure now from a risk management perspective. I see the team has bought a couple of commodity stocks more from a risk management perspective, but is usually otherwise able to find more attractive opportunities in, you can call either commodity consumers like autos or consumers overall. So that's a structural thing in the portfolio. Whether at this particular point in time, is it more opportune than other times, is again going back to the macro call. If you think that this is going to sort out in some near future, and by near future I mean next year, 2 years, I think the market's not pricing in today 1 quarter of difficulty. Market's pricing in a few years of sustained commodity prices, at least if not longer. If that gets sorted out sooner, like COVID got sorted out so quickly and pharma stocks came back to normal returns, you can have a situation where the commodity consumers really very strong because they've been under pressure because markets believe that they'll be under weak demand conditions and rising margin pressure conditions, and that would reverse. And commodity stocks, they can, as we all know, come down much more sharply than they go up. It is possible, but it's impossible to make that call. That will be making a call on the macro commodity markets at this point in time, Anuj.
Okay, Prashant, just a word for our viewers. All those marquee high valuation fintech or e-commerce stocks are the ones that have lost the maximum in the last in this rundown. Paytm is 73% off its 52-week highs, of course, even below its offer price, half its offer price, nearly. Zomato is down 69% from its 52-week highs. Ashwath Damodaran said that he would price it at 40. Yes. Well, at the moment it's 52.
Yes.
So it's getting there. PV Fintech also off about 60%. And Nykaa, which was the profit-making company in that lot, is also 51% off its 52-week highs. But to be fair to that stock, it's still above its IPO price.
It's
by 100 rupees or
price.
so.
Yes, absolutely.
Prashant,
this cheesy joke, right?
Sorry?
Cheesy joke, right? Tomato is more expensive than Zomato now.
Okay, yeah, at one point. Prashant, these high valuation but probably futuristic stocks, would you now be wanting to bite into them?
Certainly. So, Lata, again, I don't have the luxury to talk about individual stocks, but as you do. But again, from these stocks, there would emerge some very strong winners over time that would make lot of money from here, maybe lot more money than what they would have from 3-4 months ago. Just like with Nasdaq, post 2000 bubble, there was a sharp correction when Nasdaq as an index probably went down 60-70%, and today Nasdaq is down nearly 30% year to date, and from its high probably more. And if you take some of the newer age segments of Nasdaq, removing some of the very largest names, and Nasdaq is not just technology, beyond technology. So if you just take newer age names, they are in Nasdaq also down 50+%. And in 2000, 2001 timeframe, they were down 60, 70, 80%. And many of the FANG companies, while they're right now under pressure, but still they've gone up hundreds of times from that 2000, 2001 timeframe. And it would be very similar, I think, in India. Some of them would never recover. A lot of them, maybe majority of them would never recover, but that is going to be the case with many these companies. Most of them would not make money, and some of them would more than make up for the rest that don't make money. And selectivity, if you do the job right, I think there's tremendous money to be made. Yes, there is risk because you have to be hyper selective, if you will. And there remains risks of major losses even from current prices in many of these names, but some of them would rise again like the phoenix.
Out of time, Prashant, but let me ask you a last unfair question, and if you can give me a monosyllabic answer or a single word answer. What should we be prepared in terms of a bottom for this market? 14,000, 15,000?
Or is it lower?
Too early to tell.
All right.
I'm sorry. Those.
All right. 4 words, even that'll help. Okay. Prashant, pleasure. Absolute pleasure speaking with you. Thank you very much for joining us.
Thank you. Thank you, Lata. Thank you, Anuj and Nigel.
Good speaking to you, Prashant. Thanks so much for joining in. Well, the markets are under some pressure.